yeah, we've got the plan, but now let's make sure it's carried out. And as we move and grow, what more can we do? Okay, what legal things can we do to save more tax?
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel Petitpoff. I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. I'm pleased today to be joined by a tax strategy expert specifically for marketing agencies. He is the founder and CEO of Craig Cody and Company Incorporated. And after a very long career as a police officer, he's now been helping agencies specifically pay less tax and keep more of what they make. And so with all of that, Craig Cody, thank you so much for joining us today.
Well, thank you very much for having me.
I'm excited for our discussion today because I think this is the first time that we've really talked directly about tax strategy, and you specialize in working exclusively with agencies. And so I am really excited to dig into this first-class problem that we can unlock if we're making a lot of money, which is now the government wants a whole bunch of it. So how do we make sure that we can be efficient when it comes to taxes? So before we dive in, I'll let you in your own words explain who you are and what you do.
Sure. My name is Craig Cody. I'm a CPA. I have a firm. There's about 28 of us. We're based in Long Island, New York. We have employees throughout the country. We actually have 2 in London also, transplants. Our focus is a little bit different than most accounting firms. We look at the aspect of tax planning before we do anything else. So, not just putting the right numbers in the right boxes, how can we do things maybe a little differently under the rules, and then focus on putting the right numbers in the right boxes.
Yeah. Okay. And so one of the things that I find fascinating, and I'm actually genuinely curious about this question, is your focus. Like a lot of accountants that specialize in tax, that's kind of the extent of their niche, but you took it a step further and you said, no, I want to work with marketing agencies in particular. How does the tax strategy change based on the business model? How would an agency approach this differently from your perspective?
Well, the strategies don't change so much as the accounting and working with the person and what you can do, what guidance you could give them. Agencies are interesting because there's a lot of opportunities to give them different ideas. All right. If you think of a dentist, and nothing against the dentist, but a typical dentist, if he's making money, he's in somebody's mouth. Okay. Agencies as they grow, the owner, he's scaling, and he's not necessarily on the phone with the clients all the time and doing the work and stuff like that. So there's a lot of opportunities, and the more people you have working for you, the more things you really need to keep an eye on, and it's very easy for things to get out of whack really quick. So it's a lot of fun working with agencies, in addition to the fact that there are some real good opportunities in there, but you actually get to make a real difference with the owner, with the C team.
And so it sounds like a lot of this comes down to, the tax code is the tax code, but so much of the tax strategy is interpretation. And so because you have a deep understanding of the business model, you have a more discrete perspective on what kinds of things can you do within that business model to increase tax efficiency, and what is like acceptable kind of ranges of interpretation, those kinds of things. Am I understanding that correctly?
Well, everything is based on the code. So the tax code says you can do it, or if it doesn't say you can do it. So you have to always stay within those boundaries. But most of my colleagues are super focused on just putting the right numbers in the right box. Okay. Face it, as accountants, we typically have our pocket protector. We'd like to be locked in the back room. We'd like to have as little communication with the outside world as possible. That's a vast majority of, my colleagues, and that's okay if it works for you. What we like to do is we like to communicate a lot with the clients. So with our clients, we're having monthly calls with them so we know what's going on. And if you communicate a lot, okay, you get ideas, you know what's going on, you can do things. Whereas if you're having that one or two touch points a year, a lot of things have gone on. We're busy, we have a lot of things going on in our business. We don't remember everything. So it's really, tax planning is also predicated on, yeah, we've got the plan, but now let's make sure it's carried out. And as we move and grow, what more can we do? Okay, what legal things can we do to save more tax?
Right. And so let's start with, why tax planning is important to begin with. And why is it important to get ahead of this as opposed to trying to be tax efficient in a reactive way?
Anything you're proactive, at least anything I can think of that you're proactive with, you're going to be better off. All right. So if we're proactive with our tax planning and we're thinking about it all year round, we're going to be able to take advantage of various strategies and know what's going on when we need to do certain things. Oh, you're looking to do this. Oh, I'm buying a building. What can I do? How do I do that? Right. Versus having maybe that conversation in the summer, and then that, God forbid, you have that conversation in March or April when, most firms, their heads are down, they're trying to get the work done. They're just trying to get the work done, versus having the time to really think and say, okay, this is how we can do it. We have 6 months, we have 8 months, we have 2 months, whatever it is. This is what we're looking to do. This is what we need to make sure we accomplish. Versus looking in the rearview mirror and it's past, what can I do? A retirement plan? That's, or in December, buy a car, buy a truck, buy a piece of equipment. Like, if I had the option of keeping, 60 cents on the dollar or buying a truck that I don't need and keeping zero on the dollar, I'd rather pay the tax and keep the 60 cents. So, that's why it has to be constant. It has to be a lot of communication.
And so I think it's implied, but one of the things that I heard once that really changed my perspective on tax efficiency was somebody kind of alluded to, every dollar you save on tax, your marginal tax rate is the rate of return on that dollar that you accomplish in that moment. And when I reframed it that way, it was like, yeah, what investment do I know that can guarantee me a 30, 40, 50%, I'm in Canada, so 50% in some cases, return on my investment? It doesn't exist. And so it's like, if you look at it through a wealth building perspective, it really does reframe tax efficiency as being this kind of very powerful engine for, building wealth. And it's something that I think as you start to have more profit, you're met with this champagne problem and you realize the magnitude of it and just how much of a difference that can make. And so it sounds like the proactivity part really increases the ability for you to make thoughtful decisions, be tax efficient, and set yourself up to be in the right position when you arrive at that time when you need to make those decisions and submit your tax return.
And that means more money for our family, more money for charitable giving, more money for all these things. All right. And building wealth. And face it, as a business owner, right, we're working, at least 40 hours a week. Okay. Let's just, right. We're working 40 hours a week. We're under a lot of stress. We have payroll we need to make. We have all these things, especially when we're, in the growing stage and building and stuff like that. So let's take advantage of all the benefits that we're allowed to take advantages within the law. Okay? Within the law. There's plenty of opportunities within the law.
And so we're going to talk in a moment about how to actually save on tax, some of the best strategies that agency owners should be thinking about. Before we do that, because it's so related to this advanced planning, I want to talk a little bit about some of the tension that might exist within this. And so, for example, if somebody was looking to exit their business, or if somebody was looking to get financing for something, whether it be in the business or on a personal basis, those all to me seem like things that you as the person helping with tax planning would need to be aware of, because I'd imagine it's going to influence how aggressive that is, or how you structure things so that you don't end up in a situation where it's like, oh, we've decreased the taxable income of the business so much that now we have nothing to borrow against, or, situations like that could arise if you weren't thinking ahead to what the intention was, or what the plan was.
And I have a saying, document, document, document. Okay. Because if you document what you're doing, and let's face it, we're not going from $1 million of taxable income to zero. All right. That's not happening. But what we want to be able to do is when we're going for financing or when we're going through M&A, be able to clearly delineate what it is that we say, well, you know what, I need this the way I run my business, okay? But if you take it over, you may not need that, okay? For instance, you know, I need a personal assistant. Nobody says when you buy my business, you're going to need a personal assistant, you know? So there are things that we can easily line item. I don't want to have to search for, you know, Craig Cody and pull up all those bills for Craig Cody and say, you know, okay, they're all over the place and deduct them. But be able to say, okay, this line, this line, this line, you know, you're probably not going to need that person that I needed, or you're not going to need this that I needed. So they're easy. And we've had, you know, many companies be sold, M&A. It's never been a problem because it's always clearly documented.
Very good point. And that comes back to also this tension that I think is worth talking about, which is, you know, the things you're going to do to make the business tax efficient are often going to obfuscate a little bit, to your point, the reality of what it costs to run the business when we adjust for those things. And I think that lens of like, if somebody was acquiring us today, how would we adjust things is a good forcing function to say, okay, well, this is how we might want to differentiate the management reports that we look at from, you know, how we're going to file for taxes. How do you think about keeping those two sets of data kind of clean and coexisting without it becoming, you know, incredibly inefficient?
I think, you know, just like with your software, you can run a report and you could pull things into a report, okay? And then you could pull things into another report. So once again, they're separate line items, so it's easy to do. Whereas if they were all added together, it's a cluster, and we don't want a cluster. We want something that's going to be, you know, very well documented and easy to show that M&A person that, okay, well, let's, you know, I'm not going to have my daughter, you know, who's doing some social media that I'm losing money on, you know what I'm saying, or whatever it is, you know, you're not going to have this expense. All right.
So it sounds like most things in accounting, it comes back to thoughtful chart of accounts design. And to your point, getting ahead of things, planning ahead.
Right. You know, it's just like document. Make sure it's documented. You know, but if you do, you know, if you do it once a year, okay, versus every month, you know, it makes a big difference.
Hey, it's Marcel here, and I hope you're enjoying the episode so far. If you are, then I want to encourage you to check out the Agency Profitability Toolkit. It's a free set of resources that we've put together to help agency owners just like you improve their profitability. It's full of free checklists, templates, and training videos, and has helped thousands of agencies get better at measuring the essentials of their business. So if you want to grab a free copy of that, you can head to parakeeto.com/toolkit or look for a link wherever you're watching or listening to this. With that, I want to thank you again for tuning in, and I'll let you get back to the episode. Yeah, that makes sense. So with all of that said, what are some of the biggest opportunities or the most important things that agency owners should be thinking about when it comes to being efficient on tax?
Okay. Well, you know, just so we put it out there, I have a book, The 12 Biggest Tax Mistakes That Agency Owners Make, and we can give you a link, and the listener that wants it can get it for free. It's actually a paper book from Amazon, and we do have a free course. But it's really, let's think of, there are a number of things that are what I call low-hanging fruit, all right? Entity type. What type of entity are we? You know, are we a sole proprietor? Are we, you know, a partnership? Are we an S corporation? Are we a C corporation? There's certain tax efficiencies built into each of those depending on where you are. There's retirement planning, all right? What kind of retirement planning we do? And it's like, I like to say all retirement plans are not built the same. And I'm not talking about your investment choices. I'm talking about the way that plan is built. So if we're in a position where we can put a lot of money away, let's set up a plan that allows us to do that. And, you know, as an owner, you know, you've paid payroll taxes, you've paid unemployment taxes, you've paid disability income, you've paid all these things. When it comes to, you know, high level retirement, you know, we want the owner to get 85% of that money, you know, because they've already taken care of the employees. Now it's time for them to reap the rewards. So retirement planning, can be a real home run. Qualified business income deduction, right? Which is, something that came out of the Trump tax cuts, and it's basically 20% of net income. I cannot tell you how many times we've seen, decent sized agencies where this is missed. Somebody missed it for one reason or another. Okay, maybe it was just entered wrong. So those are kind of low hanging fruit. We've talked about, hiring your kids. At what age can you hire your kids? Because face it, today, if you hire a child, and let's assume they're 15 years old, and you're paying them $12,000 or $13,000 a year, they're basically paying FICA tax. So if you're in a 37% bracket and they're paying no tax, just FICA, you're talking about a 22% spread. So that's a lot of money. And if you have 7 or 8 kids, it adds up. 2 or 3 is good. 7 or 8, it adds up. I don't know if there's a cost benefit there, but so there are many different things we can do. I mean, there's the home office. Like, everyone's working from home now, right? Post pandemic. In addition to the home office, if we do have a home office, we can have a home athletic facility. Okay, that could be our pool. It could be our gym. So these are all what I call low-hanging fruit that people can do.
Okay, interesting. So talking about entities, this is one that I think comes up pretty often. How do you think about the appropriate type of entity based on where a company is in their journey? Does that typically correlate to scale, or are there other factors that you pay attention to identify the right structure?
Location sometimes makes a difference, right? Um, a typical new entity, okay, may not want to start out. Everyone says, "Oh, my friend said I should be an S corp," okay, because you save on some self-employment tax and stuff like that. But there's this thing called qualified business income deduction where, it might not make sense because, yeah, you save some FICA tax, but you're still paying more income tax because you lose this deduction. So there's an analysis that has to be done. It's not as ground ball as it used to be. And, we once had a client where we saved him like $600,000 just because he had the wrong type of entity. One little change saved him over $600,000. Now, he was making a lot of money, okay? But taking the time to look at it, do a little bit of analysis, and figure it out, all right, this doesn't make it. Whereas, if you're only going to that person once a year, okay, they likely don't have the opportunity to really get deep. Or if they do tell you something, come on, you're running your business. I have a bone saw and I have a pliers, okay? I can do amputations, I can pull teeth, but I don't, okay? Just like most agency owners shouldn't be doing their own accounting, okay? And they shouldn't be doing their tax planning because they're really good at what they do, okay? And they don't have the time to spend, all right, on the planning that they really need to spend, okay? And I'm not the only person that can do that stuff. There's plenty of really great CPAs out there that can do tax planning.
And so when it comes to retirement planning, that's another one that I'm interested to double click on. What are the big mistakes that people make when it comes to retirement planning that end up costing them a lot on taxes?
Wrong plan, okay? They have a simple plan, okay? Which means they can put away like $12,000 or $13,000 a year versus, a 401k that'll do like $22,000, $23,000 a year. And, not right now, there's a lot of credits available to if you start a new plan. And that doesn't mean going from a simple to a 401k, but somebody that doesn't have a plan, the government's going to give you up to $1,000 per employee. Okay, so if you have to put 3% away for that person, the government's going to give you $1,000. So retention, things like that, it's really good for. So we see a lot of plans where they started out and they just never got around to changing it to something that's going to allow them to put more money away. Because once you have a 401k, then you could have a profit sharing, then you could have a defined benefit plan, and get a couple of $100,000 deduction maybe, right? And if you're making money and paying a lot of tax, it gets to a point where you don't need all that disposable cash, especially if it's going to wind up only inside of your brokerage account outside. If we could put it in and get a deduction, it's a win-win. And we just made 33% on the money.
Yeah, and that seems to be like when I talk to people who really who really understand tax at a high level, it seems that the common thread is, yeah, when you reach a point where you have excess income that you don't need the cash, to sustain your lifestyle, a lot of this comes down to essentially moving that into asset classes that can retain that at a low tax rate, or that can help you defer taxes, or that can create a tax benefit through some kind of a accelerated depreciation. But that seems to be the strategy, is like we're taking that money and we're trying to essentially hold it in some other kind of form, in some other kind of entity, or in some kind of asset until we need it, at which point, there might be a tax benefit at that point in time. There might not, but that in my mind is kind of how I see a lot of the strategies end up playing out, outside of the obvious stuff, which ends up being trying to maximize how much of our expenses we can actually write off within the boundaries of the law.
Right, within the law. Yes, and accelerated depreciation comes into play mainly, with real estate, and, real estate by nature is passive. So if we generate a loss, we don't really get the benefit of it, but there are ways to set it up that you may be able to get the benefit of. Just take some planning, okay? Take some planning.
Real estate's interesting because it's one of these asset classes where it could be generating cash in some cases if it's being rented. It's usually appreciating objectively, but from a tax perspective, it's this thing that has to be maintained that you could write off. So that's an interesting one to me, is real estate. Now, of course, I don't fully understand the implications of it, but it seems like a pretty powerful vehicle for a lot of people, especially if they want to, for example, own their building that they're in, or, get a commercial building that they lease and then sublet out to other vendors.
Yes, especially in the US, there's a lot of benefits to owning real estate. You have to just be careful, if it's generating a loss, how big of a loss, and do you get the benefit of the loss? So too often people will come, I want to buy this house. I'm going to turn it into a rental property. And, can I deduct the cost of the house? No, you can't deduct. We have to depreciate it, do it over 27 years. But if we do an Airbnb, can we change it? Yes. Then we get some benefits if we do an Airbnb because it's a short-term rental. So there's a lot of different pieces that go into it, all right, that, you just have to take the time and plan out before you do. So you don't go in thinking A and wind up with B.
Yeah. And most importantly, you don't end up behind bars because
you
did something you thought was good. That's where somebody like yourself is worth their weight in gold.
Yes. Yeah. We don't, and like I say, I have a license. I worked hard to get my license. I'm not giving up my license. So yeah, take the time, do the planning, work with a professional. Okay. We did a research study last year, and, there were 3 basic groups of agency owners, and two to 3 see the value, and then there's a third that don't see the value. And that's okay. Probably just like the guy that doesn't like to go to the doctor, probably had a bad experience and he doesn't want to go back to the doctor. So I think it's important to have the communication and work with somebody that can speak, plain English. Okay. Start talking Google ads to me and all those kind of things, and it's going to go way over my head. And I need to talk to you about what I do in a way that everyone can understand.
So with that, Craig, for those that want to learn more about you and what you do, of course, we have the ebook and the physical book from Amazon that I'll link in the show notes for people to get a free copy. We'll also get a link to your course in there. Is there anywhere else that people should go to follow you and the content you create?
We're on LinkedIn. They could obviously go to our Facebook page, and they could go to our website, which is probably the best spot. We have a link to the agency research report, which is pretty interesting. You can find that on our website. But definitely, we're relaunching our podcast also. We had stopped for about a year, going to be relaunching that at the beginning of the year. So, there's a lot of stuff out there. And they could always reach out to us via email or phone.
All right. Well, I will leave all of those notes in the show notes. So if you're listening, just scroll on down. They'll be right there for you. And with that, Craig, I appreciate you making the time. This episode was long overdue. It was like trying to get the president of two countries to meet. I think our assistants were really running rampant trying to get this in the calendar, but we finally did it. And so I appreciate you being here. I really enjoyed our chat.
Thank you very much. I appreciate you having me.